So really the whole financial game that we're all playing is the line on this chart. How are you going to outpace it? We're going to talk about the S&P 500, real estate, and inflation, but maybe not in the ways that you would expect. And this is a follow-up video to a video on M2 that we did a few weeks ago that we got a lot of feedback on. So hopefully this helps clarify some of the questions that we have coming in around that video. That original video will be linked in the description of this video, so you'll be able to find it somewhere, but let's dive right in. So the first chart is Canada's money supply, or M2. We believe you have to outpace this line, or the growth of the money supply, if your income is to grow or your financial net worth is to grow, and for you to increase your purchasing power. Because if you don't increase your purchasing power faster than this line's growing, you're just falling behind. So let me use an example to really illustrate this. So here we have $10,000. Imagine I was lucky enough to save up $10,000 in the year 2000, and I tucked that money away. But that $10,000 represented a percentage of all of the money supply in this country. Well, if I divide that $10,000 by all the money that existed in the money supply as a measurement of M2, at that time, you can see the percentage ownership of the money supply that I controlled with that $10,000. That's the purchasing power that $10,000 represented to me and my family. Now, let's say I tucked that money away and I didn't earn much interest in it, because interest rates have been low for like so long. They've crept up a little bit higher now, but during the last 20 years, they really weren't that high. So let's just say I had the $10,000 and I just kept it tucked underneath my mattress. And that $10,000 now, in the current day, how much purchasing power does it have? Well, we have to take that 10,000 and we now have to divide it by all of the M2 that exists today. And if we take that $10,000 and we divide it by the M2 level that exists today, we can see the percentage ownership that I control of the money supply with that $10,000 is substantially less. In fact, I have 1/5 of the purchasing power that I used to have, or my $10,000 has gone down 80% in purchasing power. So I have lost a huge amount of purchasing power, not because my $10,000 has changed. It's because the amount of M2, or the money in circulation, has grown so much, it's been debased so much that I control less purchasing power. And it's why I don't really like looking at CPI as a measure of inflation, because I don't really believe what the government's telling me when it comes to inflation. They tell me prices are up 2.5%, 3%, but if I go to the grocery store and I try to buy steaks or hamburgers, I feel like the prices of steaks and hamburgers are up way more than 2 or 3%. So I like to just go right to the source, which is the M2 money supply, and let's measure how much that has grown. And over the years, if we go back to Stats Canada's website and we measure this stuff, the debasement of our currency is really on average about 8% a year. So if you go all the way back to 1969 to present day, it's on average, we're losing 8% a year in purchasing power. So if your income or your net worth doesn't grow 8%, that's like the hurdle rate. If it doesn't grow higher than 8%, you're actually falling behind every year. And some years it's more and some years it's less. Averages are a little bit of a dangerous metric to use, but it does give us a frame of reference on what we have to achieve in the growth of our income or net worth. So I don't like looking at CPI. I much prefer looking at the M2 money supply. To me, that is the honest measurement of inflation of the money supply, not what the government reports as CPI. Everyone can do what they like. If you want to trust the government in the CPI measurement, have at it. This is what I like looking at for inflation. And in the last few years, here's a tweet I put out a little while ago, M2 since the pandemic has grown an incredible amount. In fact, it's up about 33% just here since the year 2020. Which is much faster than 8% a year. So it's grown 33% since the year 2020. So we are getting debased much faster. So your investments have to work really hard. Your income better be growing really fast, or you're losing purchasing power. It's why we all feel the pain of prices at the grocery store the way we do. So now let's look at the S&P 500. And I'm really not here to crap on the S&P 500 at all. I just want to use the S&P 500 as a frame of reference to think about this stuff. So if we look at this chart of the S&P 500 going back to the year like 1993 or whatever it is, it really looks like it's up a huge amount, 900 and some odd percent. It's like a huge return. But if we take that chart and we say, okay, maybe I invested in the S&P 500 since the year 2000. There was like that was like the peak of tech stocks and stuff. I jumped in and I invested in the S&P 500 at that time. What would my return be today? Well, if we take the S&P 500 from the year 2000 and we divide it by the growth in money supply in the US, so now I'm flipping to the US and using them as an example, but the same principles apply to us here in Canada. If I invested in the S&P 500 and I divide it by the growth of the money supply, the M2 in the US, you can see the S&P 500 is actually down 26% in purchasing power. So I've invested for all these years, but my purchasing power is actually down compared to the amount it would have been back in the year 2000. And someone might say, well, Tom, you're like cherry picking dates here. And I'm like, okay, well, let's look at this a little bit further. Let's look at this next chart, which is me investing in the S&P 500 at the year 2008, right when the great financial crisis was like taking off. From the year 2008 to present day, if I divide the S&P 500 by the debasement of the M2 money supply in the US, I'm only up 19% purchasing power terms. And then you might say, well, okay, Tom, I'm the best stock picker ever, or, investor ever. I'm going to jump in 2009 when the S&P 500 was at that low point. So let's measure it from that low point of 2009 to current day. If you invested right at the low point during the great financial crisis, you're like the best investor ever. When everyone else was panicking, you were investing. To current day, you are up. You're up 145%, which is really good. But that's you picking the best day in 2009 to invest in and holding to the year 2023. Let's look at some more data here. So if I look at the S&P 500 from the year 2013, I can see, so last 10 years. So now I invest in the S&P 500 for the last 10 years. And you can see it's a pretty nice return. It's like 151% or whatever it is here on this chart. Like, okay, that's pretty good. But let's take into account the debasement of the M2 money supply, the growth of the M2 money supply. So if we take that chart from 2013, a 10-year investment, so you invested a decade in the S&P 500, and we divide it by M2, you can see you're really only up in purchasing power terms 31%. And this is why I think we need to take into account in all the investing that we do, how much our currency is being debased. Because if you're not, it's kind of like, you're running to get ahead, but you're running on a treadmill. You're running to get ahead, but the treadmill is going the other way, so you're never really getting ahead, even though you're thinking you're moving. You need to look at M2, otherwise the measurement of what you're trying to measure, your purchasing power as a family, if it's getting ahead, is really happening or not. And if we switch now a little bit to real estate, and if I look at this real estate chart, this is a chart of Toronto real estate, which everyone knows, like, it's been on fire for years. You can see this chart went up into the 1990s, it came down. Our family actually lived through that in the 1990s. That was a pretty horrible time in the real estate market. And then from like 1996 or so, it just kind of went up. 2017, there was a bit of a drop. We're currently in a little bit of a soft point, but you can see over long periods of time that real estate went up. And everybody focuses all their attention here. But when I see this, and people argue online, like real estate prices are too high, they're gonna collapse down, or they're gonna go further, there's population growth, and everybody kind of argues about this price of real estate. If you measure this, the growth of real estate in this area, in the Greater Toronto real estate area in this example, and it applies pretty much to all of Canada, it's grown like 7.5% on average. Well, Canada's money supply, if I flip to this chart, Canada's money supply has grown at roughly the same average rate. So even though the price of real estate has gone up, your really purchasing power of that real estate hasn't gone anywhere because your percent ownership or control over the money supply really hasn't outpaced the debasement of the money supply. So why is it that people who own property or income properties generally have a bit of net worth to them and generally maybe have a bit more financial means than other people that don't have real estate? And to me, the reason is this: it's the leverage of real estate. It's really just the leverage of real estate that allows people to get ahead. So in this example I'm showing here, if you put 20% down, which is a common down payment in Canada to buy an income property, if you put 20% down, and on average, Canadian real estate goes up 7% or so, and I'm rounding here, I'm trying to be conservative, it's actually a little bit more in the Greater Toronto Real Estate Board stats, but on average, 7% a year. Well, 7% gain on a property, if you only put 20% down to control that property, the return on your 20% is actually 35%. So if you put 20% down and you control 100% of the property, and that 100% goes up 7% in 1 year, that is a 35% return on your original 20%. Now map that forward a few years. that is outpacing the level of debasement in this country. It's why people who have one income property or two or three are quote unquote like getting ahead financially. It's just the leverage. Everyone can argue about real estate prices. Are they good, bad, sideways? It doesn't really matter. The thing that's kind of good about real estate, it's the easiest way for the average Canadian to get leverage through the banking system. Banks will gladly lend for whatever reason, typically the income that it generates, but for whatever reason they've decided real estate is something they will lend against. So you or I can go into the bank and borrow to buy real estate. It's a little bit harder to use this type of leverage with many other asset classes. And then on top of that, with real estate, if the property does go up in value after a certain amount of years, if you're lucky enough to survive, the ups and downs of dealing with tenants and interest rate changes and all that stuff, you can go refinance your property, extract the original 20% if the bank is going to allow you to, use that to buy another property, and your first property you can still own. If that's the case, you now have an infinite return on your first property. And Nick and I and a bunch of investors that we know have done exactly that. Let the property go up in value, refinance, take out your original 20%, use that to buy another property. Now the first property you have really no money in and it continues to grow. So this amount of leverage is really what gives you the benefit of owning real estate. It's not really anything else about real estate in and of itself. It's the leverage that you get with real estate. And with real estate, we shouldn't forget the other benefits, that you're paying down your mortgage over time. Ideally, you have some cash flow that's working for you. There's tax efficiencies that you get with owning rental properties, and you're paying back debt with cheaper dollars. So over time, you're paying this property back with cheaper and cheaper dollars as the money gets debased. So that's something else we need to consider with real estate. Often on this, we talk about Bitcoin as well. And it's really the reason that I like Bitcoin so much is that Bitcoin has a controlled supply. There's a finite supply. So that if you buy a piece of Bitcoin, you are buying a fixed percentage of the Bitcoin supply that no one can really change. And that's kind of why we like Bitcoin as well. Bitcoin's different. Real estate, the benefit of real estate is the leverage to me. The benefit of Bitcoin is that when myself or my family buys a piece of Bitcoin, or you and your family, the supply is fixed. So it can't be debased. There's no politician or central bank on the side increasing the supply of Bitcoin. So if your family takes a bunch of Canadian dollars or US dollars and exchanges that for some Bitcoin, the amount of Bitcoin that you have is going to be set. So no one is monkeying with the supply of Bitcoin, so your purchasing power is protected. It's an open network, it's permissionless, the governments can't control it. And that's why sometimes you'll hear us talking about Bitcoin, because it's this other thing that really allows us to protect our purchasing power. And here I have a chart of Bitcoin, kind of just almost, I guess, since its inception, how much it's gone up. And then this next chart I have divided against the US M2 money supply. So you can see that even when measured against the debasement of the currency, the Bitcoin price is still way up in dollar terms. And I'm just sharing this to just think about what we think is the most important thing to pay attention to, and it's really the money supply, the liquidity in the system. How much are the governments debasing the currency? How much are the central banks debasing the currency? And when they pay for things through deficits and debt, how much of the purchasing power are we all getting robbed? The time and labor that we are putting aside for our lives and exchanging that for dollars, when they debase those dollars on the side by running debt with different deficits that they're running, that's technically robbing me from my time and my labor. And it's, to me, not a fair measurement to use CPI to measure that. I'd much rather look at the whole thing. The M2 money supply is my preferred metric, yours might be something else. And real estate is one of the things that we like to outpace this debasement because of the leverage that real estate offers. So hopefully you found this a little bit useful, gets you kind of thinking a little bit about this stuff. And that's it. Until next time, your life, your terms.